The United States is spending over $1 trillion a year just to pay interest on its old debt. This doesn't build any new bridges, create any new jobs, or raise anyone's wages. It's simply the cost of maintaining a debt structure that has ballooned for years. Meanwhile, the stock market continues to hover near its historical highs. Unemployment remains low. The headlines talk of a soft landing and the resilience of American consumers. But if things were truly stable, why is the federal debt exceeding $34 trillion? Why are interest expenses rising faster than the defense budget? And why are more and more economists warning that the current financial structure is far more fragile than it was before 2008? One of the most controversial voices is Peter Schiff, who warned of the global financial crisis nearly 2 decades ago. This time, he suggested that if a shock were to occur, it could make the 2008 crisis look like a side exercise. This wasn't just a sensational statement. Behind that warning were 3 quietly accumulating hotspots. First, the cost of borrowing for the U.S. government is rising exponentially as interest rates remain high. Second, the current debt structure isn't just confined to banks or the mortgage market, but spans from households and businesses to the federal government. Third, the room for monetary policy is shrinking. If the economy slows, sharp interest rate cuts could trigger a new inflationary spiral. These facts, when put together, don't paint a pleasant picture. The 2008 crisis began in the housing market and the derivatives financial system. Today, the weakness isn't in a single segment. It lies within the entire debt structure of the world's largest economy. The problem isn't on a single Wall Street chart. It lies in the balance sheets of individual households burdened with high-interest credit cards, in the federal budget borrowing to pay off old interest, and in the belief that the system can still self-correct as before. When an economy has to borrow more just to maintain its current state, the story is no longer simply about growth or recession. It's a story about limits. The limits of debt. The limits of monetary policy. And the limits of confidence. The mainstream picture is telling a relatively stable story. But beneath that surface, cracks are beginning to show. On the surface, the U.S. economy is still portrayed as an incredibly durable machine. GDP growth remains positive. The labor market continues to create jobs. Unemployment hovers around historically low levels. Household consumption, the cornerstone of the U.S. economy, has not collapsed. The stock market, after short-term corrections, remains at historically high levels. In financial news, the phrase soft landing is frequently mentioned. The central argument is, the Federal Reserve has raised interest rates sharply to curb inflation, and the economy has not fallen into a deep recession. This suggests that the structure of the U.S. economy is more resilient than anticipated. This narrative isn't entirely wrong. The banking system is now better capitalized than it was before 2008. Stress tests are conducted more frequently. Regulators are more vigilant. Consumers entered a high-interest rate cycle with savings levels that had surged after the fiscal stimulus during the pandemic. From a data perspective, there is reason to believe that the system has learned its lesson. But this framing focuses primarily on aggregate macroeconomic indicators: GDP, unemployment rate, corporate profits, stock market indices. These numbers measure the size and momentum of the economy, but do not directly measure the accumulated pressure in the financial structure. For example, a low unemployment rate does not reflect the quality of jobs or real income after inflation. A rising GDP does not indicate whether that growth is financed by debt or by sustainable productivity. A rising stock market does not equate to the financial health of the middle class. On the surface, high public debt is explained as a normal part of a large economy. The U.S. has the ability to issue bonds in its global reserve currency. Demand for U.S. Treasury bonds still exists. The U.S. dollar still holds a large share of global foreign exchange reserves. The familiar argument is, as long as investors have confidence in U.S. bonds, the debt structure can be maintained. And indeed, the market has so far absorbed the volume of new issuance. But one detail is gradually changing in the structure: interest expense. With interest rates remaining much higher than in the 2010 to 2020 period, the government has to refinance old debt at significantly higher interest rates. This causes total interest expense to balloon faster than nominal economic growth. In newspaper headlines, interest expense often appears as just a small line in budget reports. But when this figure approaches or surpasses other large expenditures, it is no longer a technical detail. Another point in the surface story is the belief in the ability to pivot policy. If the economy weakens, the Fed can cut interest rates. If the market becomes volatile, the government can launch stimulus packages. History after 2008 has set a precedent: whenever the system falters, liquidity is injected. That belief has become a form of psychological insurance for the market. However, the current context differs from 2008 in one crucial aspect: inflation has consistently exceeded targets in recent years. This makes monetary easing more complicated. If the Fed cuts interest rates too quickly while price pressures are not yet fully stabilized, the risk of inflation returning is no longer a far-fetched assumption. Therefore, the policy space is no longer as wide as before. The surface narrative still seems plausible when viewed through the lens of composite indicators. But a deeper analysis reveals opposing forces at work simultaneously: sustained growth, but heavily reliant on public spending; a strong labor market, but high living costs; a stable financial system, but increasing debt leverage. The indicators may not yet be signaling a red alert, but they are not designed to provide an early warning of the gradual erosion of the financial foundation. When an economy is judged primarily by growth and profits, the pressures on the daily lives of millions of households are easily pushed out of the picture. And it is at that foundation that other signals are becoming clearer. At the household level, the picture is no longer as simple as GDP charts or the S&P 500 index. Nominal income has increased, but real income after adjusting for inflation has, in many periods, risen more slowly than the cost of living. Rent, insurance, food, and essential services have escalated faster than the rate of wage improvement for many working groups. Meanwhile, credit card interest rates have climbed to their highest levels in decades. Auto loans, consumer loans, and student loans are all under greater financial pressure than in the near-zero interest rate era. When interest rates rise, the pressure doesn't appear immediately. It comes with a delay when old loans mature, when consumers need refinancing, or when the minimum monthly payment starts to account for a larger proportion of their income. Credit card data shows total outstanding debt has surpassed record levels. Delay rates are starting to rise among some low-income groups and young people. These figures aren't yet a widespread crisis, but they signal behavioral patterns. When millions simultaneously increase short-term borrowing to maintain their living standards, it's no longer just impulsive spending. It's a sign of financial contraction. The middle class, considered the backbone of the American consumer economy, is facing a paradox. Paper asset values may increase thanks to the housing or stock markets, but the cost of maintaining a monthly life is heavier. Rent is rising. High mortgage interest rates are making new home purchases difficult to access. Health insurance and healthcare costs continue to be a long-term burden. For young people, especially those entering the workforce after the pandemic, the double pressure is evident: high housing prices, high interest rates, and unresolved student debt. Building wealth has become more difficult compared to previous generations of the same age. In lower income groups, savings accumulated during the fiscal stimulus period have gradually dried up. As the financial buffer thins, any small shock, temporary job loss, unexpected medical bills can push households into a spiral of short-term debt. An economy can sustain growth as long as consumption is sustained. But the question lies in the financing of that consumption. If spending is sustained by sustainable real income, the structure is stable. If spending is sustained by short-term debt and dwindling savings, the structure becomes more fragile over time. The biggest paradox is that low unemployment is often seen as evidence of economic health. However, many employed households still feel increasing financial pressure. This creates a gap between macroeconomic data and microeconomic sentiment. When people have jobs but still have to tighten their spending, postpone buying houses, delay having children, and reduce long-term consumption, the consequences are not immediately reflected in GDP. But it changes collective behavior. Collective behavior is the crucial variable. An economy that relies on consumption, accounting for more than 2/3 of GDP, cannot be separated from consumer sentiment. When sentiment shifts from confident to defensive, the momentum of growth begins to slow, even though the composite index hasn't yet reacted. Individual stories of financial pressure are not exceptions. They are repeated on a large scale. Workers working overtime but their income is insufficient to keep up with costs. Young families postpone long-term plans. Small businesses see customers tightening their spending. This divergence doesn't appear naturally. It's not the result of a single individual choice. It reflects a structure in which the cost of capital is rising rapidly, while productivity and real income are increasing more slowly. And as that structure persists, the pressure isn't just on households. It begins to spill back into the financial system, where debt leverage exists not only at the consumer level, but at the national level. To understand why warnings of a crisis more severe than 2008 are no longer far-fetched, we need to move beyond the surface manifestations and look at the operational structure of the current financial system. The first link is public debt and interest costs. For more than a decade after the 2008 crisis, the U.S. maintained extremely low interest rates. This allowed the government to borrow cheaply and expand its balance sheet without creating immediate pressure on the budget. When interest rates were near 0%, even a massive amount of debt could be maintained relatively easily. But when interest rates rose sharply to combat inflation, that entire structure changed. The federal government had to refinance maturing bonds at much higher interest rates than before. The mechanism here is clear: high interest rates rightward arrow increased borrowing costs rightward arrow expanding budget deficits rightward arrow need for more bond issuance. The problem isn't a single year. It's inertia. If borrowing costs continue to rise faster than the nominal growth rate of the economy, the debt-to-GDP ratio will be pushed higher over time, unless there are drastic adjustments to spending or taxes. The social consequences don't immediately appear in the financial markets. They appear in budget allocations. When a large portion of the budget is set aside for interest payments, the room for spending on infrastructure, education, healthcare, and social security is narrowed. This creates political tension and pressure for cuts in sensitive areas. The second link is the financialization of the economy. For years, asset growth from stocks to real estate played a major role in creating a sense of prosperity. Rising asset prices increased paper net worth, stimulating consumption and investment. But when assets grow faster than real income, the gap between financial value and actual affordability widens. This leads to greater reliance on debt leverage to maintain a standard of living or invest. The mechanism here operates in a chain: persistently low interest rates rightward arrow rising asset prices rightward arrow more borrowing based on collateral rightward arrow expanded leverage structure. When interest rates rise, asset valuations are pressured, while borrowing costs increase. If asset prices adjust sharply, household and business balance sheets weaken simultaneously. What makes the current context different from 2008 is the starting point. Before 2008, the crisis was concentrated in the mortgage market and the banking system. Now, leverage is more widespread. The government, businesses, consumers, and even the non-bank credit market. The third link is the limitations of monetary policy. After 2008, whenever the market experienced significant volatility, the Fed could quickly lower interest rates and inject liquidity without facing high inflation. But the recent period of explosive inflation has changed the landscape. If the economy weakens and the Fed cuts interest rates sharply, the risk is that price pressures could return, especially if the budget deficit remains large and the money supply expands rapidly. If the Fed doesn't cut enough, high capital costs could stifle investment and consumption. This is a dilemma. Easing too early could fuel inflation. Maintaining tightness for too long could trigger a deep recession. The problem with these mechanisms lies in the time lag. Debt doesn't cause an immediate crisis. High interest rates don't cause the system to collapse in a single quarter. But as pressure builds over multiple refinancing cycles, at a certain point, the adjustment can happen faster than expected. Then, the chain reaction doesn't stop at the bond market. It spreads to corporate credit, the labor market, and consumer sentiment. A system can withstand high levels of debt under low interest rates. But when the cost of capital changes structurally, the previously sustainable model can become fragile. The warning of a crisis more severe than 2008 doesn't stem from a single event. It stems from the intersection of three forces: high debt, rising capital costs, and limited policy space. And when these three forces act simultaneously, the pressure is no longer confined to a single group. It begins to spread throughout the entire economy. As pressure builds in debt structure and capital costs, it doesn't remain static at the government or bond market level. It spills over into less noticed channels, and that's where systemic risk begins to emerge. It starts at the household. As borrowing costs rise and real income growth slows, consumers adjust their behavior, reducing large purchases, postponing long-term plans, prioritizing debt repayment over spending. For a consumption-dependent economy like the U.S., this widespread shift in behavior has ripple effects. Small businesses are the first to feel the impact. As revenues slow but capital costs rise, the ability to expand, hire, or maintain cash flow shrinks. Many businesses rely on short-term credit for day-to-day operations. Higher interest rates further reduce already thin profit margins. From there, the pressure spreads to the labor market. Not in the form of immediate mass layoffs, but in the form of hiring freezes, reduced working hours, or limited wage increases. These changes are difficult to see on the big chart, but they accumulate gradually. At the financial level, the corporate credit market is becoming more sensitive to risk. Businesses with low credit ratings have to pay higher interest rates to refinance. If tightening conditions persist, the risk of default increases in high-risk segments. Another less discussed factor is the refinancing risk in both the public and private sectors. When large amounts of bonds mature in a higher interest rate environment, new costs can put sudden pressure on balance sheets. If investors demand higher yields to offset risk, the cost spiral can amplify itself. There are groups that are almost invisible in macroeconomic statistics. Long-term tenants do not accumulate real estate assets. Freelancers or those working on short-term contracts lack a stable safety net. The elderly, dependent on fixed incomes, are vulnerable to prolonged inflation. Graduates with substantial debt enter the labor market facing higher borrowing costs than previous generations. These groups don't shake the stock market in a single day, but they form the social foundation of the economy. When financial pressure becomes the long-term normal, confidence in advancement and stability diminishes. Another long-term risk is confidence in U.S. Treasury bonds. For decades, U.S. bonds have been considered the safest asset in the world. But if budget deficits remain high and interest rates continue to rise, investors may demand higher yields to offset fiscal risk. This doesn't mean an immediate collapse. But if yields rise too quickly, bond prices fall, government borrowing costs increase, and the cycle repeats. A financial system that relies on trust can function stably for long periods. But when trust is questioned, the response is often nonlinear. This is a point that many analyses often gloss over. Crises don't always begin with a dramatic event. They can begin with a slow erosion of expectations. When households become defensive, businesses cautious, investors demand higher yields, and governments borrow more to maintain the status quo, the economy enters a more vulnerable state. Warnings about a crisis more severe than 2008 are not predictions of a specific date. They are the realization that when many weak links are under pressure simultaneously, the system's margin of safety narrows. And when the margin of safety narrows, any shock geopolitical events, a slowdown in global growth, or unexpected financial volatility can amplify the impact beyond conventional forecasts. What remains isn't just the balance sheet or interest rates. What remains is confidence. In every major financial crisis in history, there's one variable that's often underestimated until it's too late: confidence. The belief that bank deposits are safe. The belief that government bonds are risk-free. The belief that future income is sufficient to cover today's loans. The belief that the system operates in the best interests of the majority. When belief remains intact, the system can withstand high levels of debt, large deficits, and short-term volatility. When belief begins to crack, economic behavior changes before the data reflects it. A household that loses confidence in future income will reduce spending even if it still has jobs. A business uncertain about future demand will delay investment. An investor doubting fiscal sustainability will demand higher yields. These reactions, considered individually, are all reasonable. But when they occur simultaneously on a large scale, they create a self-reinforcing effect. Defensive consumption slows growth. Slow growth makes businesses more cautious. More cautious businesses make the labor market less flexible. And the cycle continues. The 2008 crisis erupted when the financial system lost confidence in the real value of collateral. Today, the question is no longer limited to a specific segment. The question lies in the ability to sustain an increasingly large debt structure in an environment of higher capital costs and more limited policy space. If growth is strong enough to offset interest costs, the structure can be sustained. If inflation falls sustainably without weakening the economy, the Fed can adjust flexibly. But if one of these conditions is no longer met, the accumulated pressure could manifest itself faster than expected. It is noteworthy that financial markets often react before the real economy fully feels the impact. Volatility in the bond market, sudden changes in liquidity, or sharp asset adjustments can be early signals but not always recognized in time. Warning that a crisis could be more severe than 2008 is not a definitive statement about the future. It is a reminder that the current structure depends on major assumptions: interest rates can be controlled, investors will continue to finance deficits, consumers will maintain spending, and growth will be sufficient to absorb the debt burden. If one of those assumptions falters, the system is forced to adjust. There is no specific milestone for that adjustment. History shows that crises are rarely accurately predicted in terms of timing. But history also shows that when debt accumulates faster than the capacity to create real value, the risk doesn't disappear, it just shifts to the next cycle. Ultimately, the question is not just whether a crisis will occur. The question lies in the system's ability to rebalance itself before the social cost becomes too great, and whether confidence can be maintained when fiscal pressure becomes a persistent state. An economy can operate on leverage for many years. But it only operates sustainably when confidence in the future remains intact. And when that confidence begins to be questioned, adjustment is no longer a theoretical issue, it becomes a test for the entire structure built over decades.